Tech certainly leading the way today, up 2.5%, 2.6% among the S&P sectors. But every sector did end the day in the green, and the S&P actually closed above 4,400, 4,415. Mimi, does this rally have legs?
Well, we're a bit more cautious on the equity side, but to the extent that we see more rate stability, which I think is a good part of what's behind this week's rally. And obviously, also, we have seen the earnings beats come in. So if we can find some rate stability here, we are overweight in the fixed income, and we've started to term out some of those positions. I think that, we could that could lend a hand to the equity stability and strength.
Okay. Mike, the fact that we did close above 4,400, which had been seen as key resistance here, how bullish is that, at least in the near term?
It's another box that we checked off, that the rally does have a little something behind it. Everyone's going to be watching to see if you maybe get a little bit better distribution of these gains of the buying interest. Something that is interesting is that we also, if you go back to late September when we were last at these levels, we essentially went through the entirety of an earnings season when companies generally beat at an 80% beat rate. The estimates for the coming 12 months have gone higher. New York Fed tracking for the fourth quarter GDP is now 2.5%. So you would think the growth metrics should be supportive in here as long as yields calm down, and that probably does underwrite 4,400 being a level that we can live with without any surprises from the bond market.
Mimi, you sound cautious on equities. Where would you be putting money to work right now?
So we're overweight fixed income, as I mentioned. We haven't seen these rates, since 2006. So there's no reason to be underweight here. We still see some instability in the back end. The bond auction yesterday points to that. But in terms of on the equity side, we do like infrastructure. We like some of the real assets like uranium. We do see pockets there that we think we can have sustained strength.
Interesting. We had Mary Daly, San Francisco Fed President Mary Daly, on CNBC earlier today. And Steve Leisman basically asked her about the neutral rate and said, is it right to say that we're in a world of permanently higher government deficits and borrowing, that this is a world of higher interest rates and a higher neutral rate? Would that be fair to say? Here was her response.
So the way the neutral rate works is very simple. It's the demand for funds and the supply of funds. So savings and investment. And if the governments across the globe are using some of that investment along with the private sector, well, then the supply of funds is the same. The neutral rate's going to rise.
So, Mimi, I want to get your thoughts on that and what it means for how you are thinking about the Treasury market, which the stock market is taking so much of its cues from. Longer term, whether we do see a higher neutral rate and what that means for fixed income overall.
So I think if we do see a higher neutral rate as we come back, right now we're in restrictive territory. I don't think anybody would argue with that with funds at 5.5%. But as things move forward, if the Fed does at some point ease, where do they stop? It probably also argues for higher rates out the curve over time relative to, say, 2 and 3 years. Because remember, in a normal environment, you have an upward sloping curve where the front end is anchored more by that neutral over time, and then you have some term premium. You're rewarded by extra yield to move out the curve. So, and to Mary's and your points, the deficit right now is problematic. The Treasury is forced to fund these numbers, and issuance is up quite a bit as a result. So I think that that's the longer term impact. We're probably not likely to go back to these extraordinarily low yields that we saw in the last 10 years.